Hello everyone, welcome back. Thank you so much for joining me today. Even though the United States economic data that was released this week appears to be quite rosy, don't let that confuse you. I know the majority of us can see right through those reports, we can see right through those promises. We're being told by the BLS, the Bureau of Labor Statistics, that consumer prices in August increased only 2.5% compared to the same time last year, and compared to an increase of 2.9% in July. So the latest data seems to point to a decline in inflation, which is of course boosting chances of a rate cut. Let me know if you're seeing those price declines in your areas. I would love to hear from you and to get a better idea, a better feel of what you're experiencing. Maybe include a general area of where you're located as well. According to August BLS report, the top 3 items that increased the most were vehicle insurance, 16.5%, transportation services, 7.9%, and shelter costs, an increase of 5.2%. The housing affordability crisis is not going anywhere anytime soon. Earlier this week, JPMorgan CEO Jamie Dimon warned that the United States economy is quite possibly facing an outcome that is far worse than a recession. It would be fair to argue here that, well, actually, we have been in a recession for quite some time now, but what may follow after the Federal Reserve cuts rates at its September meeting may be far worse than the economic downturn of 2008. And yes, I am referring to a possibility of stagflation. What is stagflation? Very quickly, it is economic stagnation or a significant slowdown coupled with rising prices or inflation. The most concerning part is that stagflation results in unemployment numbers to rise. In a recession, unemployment does increase as well, but there is little to no inflation. The last time the United States experienced a stagflation was in the 1970s, when the decline in the quality of life of an average American was astronomical, as their purchasing power was completely wiped out. There are several similarities now to the events that preceded stagflation of the 1970s. First of all, the money supply grew faster than the economy at that time, leading to inflation. And this is precisely what started back in 2019, and the results of it we're still experiencing today. If we look at the supply of money in our economy now, M2, we will certainly see a steep increase over the past several years. Another fact to remember is that in the 1970s, US President Nixon devalued the US dollar to encourage exports, to make American exports more appealing. The third catalyst then, at that point in time, was, of course, the surge in crude oil prices. Prices increased nearly 4 times in the 70s. Today, crude oil prices have declined since their peak back in May of this year. However, this is just something to keep in mind, to keep on your radar, because with the escalations in the Middle East, there is absolutely no guarantee what may happen with respect to energy commodities, especially now that we are heading in the colder winter months. So I would argue that this remains to be seen, but it's certainly a considerable risk. As you can see, it is not a stretch to say that the conditions are quite similar, not the same, but arguably now they're even more challenging. Here's a quick video of Jamie Dimon discussing the possibilities of stagflation. Take a quick look.
I always say the worst outcome is stagflation. It's a recession with higher inflation. And my own view, I wouldn't take that off the table. I know everyone thinks inflation is coming down and we won that victory. I caution that a little bit because if you look forward, there are a lot of inflationary forces out there. Huge deficits, the green economy, remilitarization of the world, restructuring of trade, things like the IRA Act, the CHIPS Act, infrastructure needs, they are all inflationary. And, basically in the short run, the next couple of years. So it's hard for me to look at that and say, well, we're out of the woods. I don't think so.
Dimon mentioned higher deficits. Here's what you need to know this week. The U.S. Treasury Department just reported that the United States government spent more than $1 trillion. Just think about that. More than $1 trillion this year on interest payments alone. This is a 30% increase from the prior year. Why does this matter, you may ask? Well, it matters because out-of-control government spending, especially when we are looking at $35.3 trillion in national debt and counting, and $1 trillion and counting per year of interest payments alone, government spending actually drives budget deficits. At this time, there is absolutely no cure for that. Government deficits effectively mean that the government is broke, but because it is the United States government, it can continue issuing U.S. treasuries, and it can keep that printer on as well if it wishes to. And of course, it will keep financing its spending that way, using your tax dollars to pay for policies that you likely don't even support or even know about. U.S. budget deficit is approaching $2 trillion for 2024. The deficit has ballooned by 24% compared to last year, with an August shortfall of $380 billion. Record-breaking monthly revisions in employment data, as well as the latest manufacturing reports, do show that the United States economy is slowing down more than expected. I do believe that Jamie Dimon made an excellent point, and I'm typically very skeptical of the phrase more or less than forecasted or than expected, because it literally means nothing unless we know what those expectations were based on. And if those expectations are created the same way that those wonderful employment numbers are created, then, well, it's fair to say they're meaningless. But he does have an excellent point. And as I just showed you, there are very, very concerning red flags that we do need to keep our eyes on. Having said that, I hope that this quick video raises awareness of what to expect of those red flags that I just walked you through. There is a very high probability that the rate cuts will send prices up. The rate cut is not an economic decision this time, it is a political one, so its economic implications will likely be quite unwelcomed. Thank you for watching. I hope that you enjoyed this video, that you learned something from it. Remember to like, subscribe, and share to show your support. It goes a long way. Make sure that you are subscribed to my backup on Rumble. It only takes a moment to subscribe. You will find all of my social links in the video description below. And I will see you back here tomorrow. Enjoy the rest of your day. Bye for now.